Welcome back to Open Exchange. Marty Fridson, Chief Executive Officer of Fridson Investment Advisors, has been our guest this hour. Like the rest of us, he spent most of it watching Henry Paulson, the Treasury Secretary. But now we have an opportunity to talk, Marty. We were talking just a moment ago there about what areas you thought might present investing opportunities, again, whether it's distressed or whether it's really just credit opportunities, which is what you're prospecting for. Describe for us some of the tools or some of the techniques that you're employing to find suitable investments in this kind of volatile market.
The main thing we look at is the loan-to-value ratio for a company. We want to look at where the company would be valued if it came to the worst. And
not unlike a mortgage, for example.
Well, that's right. And as long as it could be sold for a price that leaves some cushion between the tier of credit that we're in and that total enterprise value, we could be fairly comfortable with it. We want to see some potential for appreciation as well, so some kind of catalyst that will change the picture and give us something beyond the current yield. But we want to always make sure we've got that cushion if worse comes to worse. And that's going to cause us to miss some great opportunities. They're very high-risk situations, but we know that very highly leveraged companies, if you buy them at the right moment, from time to time, are going to produce some great returns. But we're willing to forego those.
If you had to, we talked earlier about default rates. If you had to point people to other sort of barometers, really, of the high yield / credit opportunity universe, what should people be focusing on to get a sense of where this market's going?
Well, one thing to look at is the credit quality mix of the new issue calendar to look forward. That's improved very dramatically after 6 years of declining in quality. The new issue calendar quality is up very sharply in the first half, not because credits have gotten better, but because investors aren't willing to buy the lowest tier, so that's dropped away, and what has gotten issued is very high quality. That, with about a 3-year lag, should indicate much improved credit experience down the road. In the near term, one important thing to look at is the yield spreads, and a little more granularly, not only at the spread on the index as a whole, but at the different tiers, double B, single B, triple C. And at the lowest tier, you're really not getting compensated anywhere near well enough. So I think those opportunities are further down the road.
Just before the break, we talked about autos, we talked about retail, we talked about casinos as some industries that were feeling some pressure. You mentioned that you aren't looking at structured credit. I assume that that includes mortgages. But do you think that what's going on, for example, in home builders and some of the real estate services companies is still a bit too toxic to touch right now?
Yeah, I'm persuaded by those who argue that we still have a long way to go on housing prices. There will be a point at which you'll feel well covered by the collateral, and probably there'll be a lag, but right now you are still in a position of seeing further exposure. So I think it's too early to jump in on the premise that we're close to a bottom on housing prices.
And one last point. Back in April, Howard Marks of Oak Tree Capital Management, somebody I'm sure you know well, said that this is the worst credit crisis he's ever seen. Do you think at this point it's worse than it was in April, or beginning to look better?
Well, I think the Fed has inundated the system in a way, given a lot of confidence, and it gives every sign that they'll continue to prevent a disorderly failure of a major financial institution. So in that sense, it's better, but the fundamentals underlying it, I say we still have a lot of exposure. I think a lot more write-offs still to come on some of that structured finance paper.
So maybe baby steps towards market stability.
Yeah, I think that's right.
Well, our thanks to Marty Fridson, CEO of Fridson Investment Advisors. He's been our guest this hour. You've been watching